Welcome to our Taking Stock video for the week ending the 13th of October 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. Great to have you on board.
Pleasure's all mine again, Kien.
But before we get started, just a quick yet important reminder. The information we provide during this episode is of a generic nature and therefore doesn't take into account your personal situation. Remember, shares are volatile. Any charts, tables we present today shouldn't be relied upon as a guide for future performance. Well, Jace, it's been a very sad week for the world with so many innocent lives lost, and we send our condolences to those who have been impacted by the events between Israel and Hamas. But despite the heightened geopolitical risks, the markets both here in Australia and the US have rallied strongly. Equities have brushed off the Middle Eastern conflict and focus on the increasing optimism that the US Fed is done raising rates, even though rates could stay higher for longer. In addition, the retracement of the oil price and bond yields from their highs has also helped driven sentiment.
Yeah, another reason for the market bounce, Kien, is the fact that technically it appears pretty oversold, especially following September, where the US market was actually down close to 5%.
Yeah, markets don't move in a straight line, Jace, but regardless of these reasons, it's important for us to block out those short-term noise in the market and focus on our long-term investment strategy. And in the current market cycle, with slowing economic growth, putting pressure on corporate earnings, the emphasis here is on risk management.
That's right, Ken. And we also continue to witness weak consumer confidence and spending from the lagged impact of rising interest rates. In addition, inflation could actually exacerbate, and if oil prices remain elevated on the back of this Middle Eastern conflict, especially if Iran, which is a major oil producer, becomes involved.
That's right, Jace. The risk is still present. And as we've alluded to over the last 3 months, our strategy is to protect our portfolios from downside volatility. As highlighted from last week's video, investors can do this by having either some cash on the sidelines or by using inverse ETFs to neutralize your portfolio risk. Otherwise, investors may wish just to ride through the cycle by investing in those financially healthy businesses and also maintaining a diversified portfolio.
That's a good point, Ken. Over the past week, we have improved the diversification of our star stock portfolio by transitioning a number of stocks from the borderline status. And these include AXX, Super Retail Group, Brambles, and Technology One. Note that these businesses remain high quality and the fundamentals have not changed. We will merely continue to review these stocks for the potential inclusions in the coming weeks.
Yes, that's right, Jace. Diversification is the key. But one of these stocks that we're looking at the moment is pubs and drinks operator Endeavour Group. The code is EDV. Endeavour now should be considered a defensive stock, especially given that its core business lie in liquor sales through channels such as Dan Murphy's and BWS. However, the stock price has been under pressure, firstly due to changing gaming regulation in Victoria, which could impact earnings from its hotels division, encompassing those pubs and poker machines. And this could potentially hurt its earnings by up to about 5%.
That's right, Ken. And also, the company has been the subject of, should I call it, management hostilities. The Endeavour board is rejecting a push by pubs billionaire Bruce Matheson to elect ex-Woolworths executive Bill Wavish to help trigger an overhaul of its corporate strategy. Currently, Bruce holds a 15% stake in the business. If the installment of this Mr. Wavish proves successful, then it could actually represent a catalyst for reversing the weak sentiment on the stock, especially if the intention is to simplify the businesses by realizing more value through a potential divestment of its operations.
Yeah, very interesting, Jason. Hopefully that clears up some of our client queries around that, our member queries. But over the week, the investment committee came together to discuss market strategy, active risks from our star stocks, and also emerging opportunities. And these conversations really help us to remain proactive in assessing the risks of stocks that we look at. And one of these is the removal of Bank of Queensland from our Star Income Stock universe in April 2023, because we did consider it a very high risk, especially risk of dividend cuts.
That's right, Ken. And it seems like those concerns turned into reality after the company reported its FY23 result that came in pretty below market expectations, and the share price fell 8% on the day. The second half dividends were cut to 21 cents from 24 cents per share, and this was on the back of intense mortgage price competition and high funding costs. We should see a downward revision to its dividends and forecast dividends yield over the next coming days.
Yeah, that's why, Jace, it's important for members to continue to read those active risks and the strategic comments for some of our stocks, just to keep updated on, whether it's relevant for them, that stock, and are they comfortable with those risks. But the other benefit of Stock Doctor is that you can find hidden gems and emerging opportunities using our powerful filter tool, and you can run a list of ideas using Tim's growth or income filter with potential, or you can create your own using a variety of our fields and thresholds. But one of these emerging opportunities of the week that we'd like to highlight today is called Trajan Group. The code is TRJ, and it's a scale-based manufacturer of precision medical instruments and products. Now, the company has a market capitalization of around 200 mil and liquidity of around 60,000 average daily traded.
Yeah, and to provide some context as well, the share price has fallen sharply on the back of lower earnings expectations, and this was due to the inventory destocking by major clients, which has resulted in smaller orders and less forecast sales for the next period. Our investment thesis is premised on the fact that the end of the destocking trend appears near, and this should stem the rate of negative earnings revisions going forward. Earnings growth and ROE is expected to accelerate on the back of this, but potential investors should note that there is a degree of uncertainty in the forecast numbers due to the low analyst coverage.
Yeah, the earnings revisions there look a bit concerning, Jace, but yeah, the share price may have factored that in. But also I notice that a key positive with Trajan is that it's a founder-led business with the CEO, Stephen Tomasic, owning more than 50% of issued shares, reflecting alignment of management with their shareholders.
That's right, Ken. It's very important to look for that skin in the game. Looking into the corporate calendar ahead, we have a couple of star stocks expected to report their AGMs, which include Cochlear, IDP Education, Telstra, AXX, and RPM Global.
Now, in Under the Microscope this week, we look at global biotech and flu drug maker CSL. The business has been under significant share price pressure in recent months. And if you can recall, in June, CSL downgraded its earnings guidance on the back of currency fluctuations.
That's right, Ken. The company reports in US dollars and generates over half of its revenue overseas. And the strength of the US dollar relative to other countries means that earnings from overseas jurisdictions are penalized because they translated back at a higher USD rate, which means lower earnings from that jurisdiction. In addition, there have also been ongoing concerns that CSL could potentially lose market share due to generic drug competition.
Yeah, a lot of active risk there, Jace. But this week, CSL did drop by another 6% on Thursday. Can you explain the driver of this?
It just seems like the bad news keeps on rolling for CSL. Following the US market close on Wednesday, European pharmaceutical company Novo Nordisk announced an early conclusion of its trial for semaglutide in the treatment of chronic kidney disease. If you may recall, semaglutide is the active ingredient in the weight loss and diabetics drug Ozempic. So the early conclusion of the trial suggests high efficacy for semaglutide as a potential treatment for kidney disease. Now, this could turn out to be a negative catalyst for CSL because 45% of Vifor's revenue is exposed to the treatment of kidney disease, which implies that 8% of the group's revenue and potentially net profits of the same amount could be impacted in the future.
Right, Jace. And looking at the share price under Golden Rule 4, it appears to have breached the SD30 TSR. So trend-sensitive investors should be out of the stock until the trend changes. And I notice also under Golden Rule 5, the stock is now trading at a large discount to fair value. This will also be likely revised lower in coming days as well. Jace, does this represent an opportunity for long-term investors, or do you see further earnings risk down the track?
Look, it's a very good question, and one probably on the mind of many investors. The pharmaceutical sector is highly competitive, Kien, and CSL has seen its fair share of threats. And this ranges from generic drug substitutes to alternative forms of treatment, which could reduce patient volumes. I feel there's a bit of market hype around this use of semaglutide, which has opened up a number of opportunities, especially from markets' fears for selling down fast food operators in the US like McDonald's, KFC, to even ResMed and now CSL. While nobody really has a crystal ball, it's unlikely that this miracle drug is the panacea for all ailments, which leads me to believe that it could be an opportunity for longer-term investors to take advantage of the price discrepancy and maybe increase their position or look to establish a stake in these high-quality growth companies.
Yeah, for now, I think we've retained the stock in our Star Growth Stocks universe, mainly because the share price has appears to be factored in a lot of these risks, but investors will need to be comfortable with these risks before jumping in. Note that the company has undergone a management change after Paul McKenzie took the reins in March. And at its AGM just recently, investors displayed their displeasure with CSL remuneration report, which details excessive performance rights of around 7.7 million to Mr. McKenzie. The latest report also removed the performance of the Swiss acquisition Viva from its bonus targets. So just be mindful of that before jumping in. In recent weeks, we've seen a significant share price decline across those lithium stocks, especially our star stocks, including IGO, Allchem, and also Pilbara Minerals. So a useful question for this week is, should investors be concerned about these large share price falls?
Another good question, Kien. Look, as mentioned in our previous commentary, lithium stocks are extremely volatile because the underlying market for lithium is still in its infancy. Hence, we are actively encouraging members to manage risks in their portfolios accordingly. And you can do this by either ensuring there is sufficient diversification or having appropriate position sizing in place. Now, the recent sell down has been driven by a continuation of falling lithium prices, which has now been down roughly 80% from their peak. This isn't unexpected. For example, Pilbara made an operating profit margin of 83% and had a return on invested capital of over 400% in FY23. These levels are unsustainable and should be expected to normalize over time, Kien.
Yeah, investing in resources can be quite volatile, but it's also important to note that despite the declines, lithium prices are still well above the cost of production across many of our star stocks. And this means that they will continue to be profitable. But keep in mind, as profits come down from their peaks, our star growth stocks, including IGO, Pilbara, and Allchem, they may fail to meet Stock Doctor's growth criteria under Golden Rule 3. And that's due to the decline in ROIC.
And on another note as well, Kien, industry experts suggest that electric vehicle sales in China have slowed in the past few months, and this is likely to remain subdued heading into the Lunar New Year. So we may not see any significant turnaround in the lithium market until the second quarter of FY24 or calendar year 2024, sorry.
Yeah, that's right, Jace. But thinking longer term, though, the thematic of decarbonisation will continue to drive growth in the market, with some experts suggesting that demand will grow by around 25% per annum. And if these forecasts are even remotely accurate, then we will need a lot more investment into lithium supply. Otherwise, prices will remain higher for longer. That's all we have time for in this episode, Jace. But again, your insights are very valuable here.
Thanks for having me as always, Kien. It's my pleasure.
And for those who have any questions on today's episode or stocks in general, please come along to our Lincoln Live webinar on Monday. But to summarize today's episode, geopolitical risks, interest rates, and oil prices, it's important to block out the noise, keep your emotions at bay, and focus on your long-term investment strategy. And if you have concerns about the active risks for our star stocks, such as CSL, please feel free to give the analyst team a call. Take care and have a happy, healthy, and prosperous week ahead.